We are very much known for our style of value investing, which is private market value with a catalyst. So we are the ones who first came up with that style of investing. We have implemented it consistently for over 35 years, and it has been the same people, the same team, the same philosophy, the same approach during that time frame, and we've been able to generate a very strong track record during those 30-plus years in business. We have a very research-driven culture at our firm. We do our own research. We're not buying research from Goldman Sachs or Morgan Stanley or any of the big investment shops. We have a large team of over 35 dedicated analysts following the companies that we look after, and we're big believers in doing our own research. We have grown nicely over the years. Again, our firm was founded well over 30 years ago, and we have now grown to almost $50 billion in U.S. assets under management. This is just an overview of the portfolio management team on the value side. Again, as you heard, Mario Gabelli is an exceptionally well-known investor on Wall Street. He is the founder of the firm and the chief investment officer, and then there's a team of portfolio managers working with him. I am one of those people on that team, and all these portfolio managers have deep experience in value investing and applying private market value with a catalyst. Also on the team, we have some other products at the firm. Again, Rocco, who you see here on the slide presentation, is here to talk about the product that he is in charge of, which is the merger arbitrage product. And again, he will get into the specifics of that in just a little bit. So for the U.S. Value Fund, again, it is a value style of investing. We are unlevered, meaning we do not use any debt to try and increase the returns. It is unhedged, and we are applying bottom-up, fundamental, traditional research to pick individual stocks for the portfolio. We are not what's called top-down managers. We do not look at the macro environment and then buy stocks depending upon our macro outlook. We are looking to invest in individual stocks, individual companies, understand those companies, research those companies, and invest in the companies that we think are best positioned to grow shareholder value over the long term. So it is very much of a bottom-up, stock-specific process of building the portfolio. And again, we have consistently applied the same process, the same philosophy since the founding of the firm over 37 years ago. Again, we put great emphasis on the research part of the equation. As I mentioned, we have over 35 dedicated analysts, most of whom have gone to top business schools and have spent years and years in the industry. They are meant to be experts in the industry. They spend their day going out meeting with the different companies that they're following. They spend their days reading the annual reports, reading the financials, learning all they can about the industries that they are following. Again, we are not relying upon Wall Street or Goldman Sachs or anybody else to do the research for us. We are doing it ourselves. Now, I just want to spend a little time explaining more the private market value with a catalyst approach. What private market value is, it is an estimate for what an industrialist or an informed investor would pay to buy an entire company. So we are going through the process of looking at many, many different companies and coming up with our estimate for private market value. What would someone pay to buy this company in its entirety? We are essentially looking at the world through the eyes of a private equity investor, trying to determine how much is this company worth if it were to be sold. From that, we are then looking for companies that are trading in the public markets at a significant discount to our estimate of private market value. And the greater the discount, the more, as we say, margin of safety there is. And we are looking for companies that have good margin of safety, that have a nice discount between our estimate of the private market value and what the stock is trading for in the public markets. From that, we then apply the second part of our process, which is looking for a catalyst. We are looking for something that is going to enhance shareholder returns. It can be either company-specific, or perhaps it can be industry-wide. It could be deregulation taking place in an industry. It could be many things on a company-specific basis, such as a new management team coming in, a company spinning off or selling different divisions, or aggressive share buyback program. Those are the types of catalysts that we like to see when we invest in a company. We call this our pyramid chart, and it just briefly goes through the process of how we develop the portfolio for you. Again, it starts at the bottom of the pyramid with the research. So again, we put extensive resources behind our research effort. Again, it's well over 35 analysts following approximately 2,000 companies. And from those that we like the best, again, we're going through the process of building our own financial models, looking out over the next 5 years, coming up with our estimate for what that company is worth on a private market value basis, trying to find companies that are selling at a discount. And then again, we apply the catalyst approach, looking for companies that have some sort of catalyst to surface shareholder value. And from that, again, we're building the portfolio one stock at a time using bottom-up fundamental research. So in our portfolio, again, we hold approximately 40 stocks in the portfolio that we run for you with Credit Andorra. This is just a quick list of the top 10 holdings in the portfolio. You probably recognize some of these names. And to just give you an overview of where some of the weightings are in the portfolio. Our biggest weighting right now is in the healthcare area with 20% of the portfolio. Much like in Europe, the United States population is aging, and over the next number of years, there will be a greater need for healthcare services as the population continues to age. And again, we think the American industrial economy is poised to do quite well in the years ahead, so we have a strong position in the industrial sector. And we also have meaningful exposure throughout the consumer areas. Again, we think the middle class in America is going to do very well, and we think there are an awful lot of American companies that have brands that sell on a global basis that are poised to do well as the world's middle class continues to grow and can consume more consumer products.
And we've actually had a dedicated product that has invested in this strategy for nearly 30 years. Now, what is merger arbitrage? Well, merger arbitrage is an event-driven absolute return strategy. By absolute return, I mean the goal is to earn a return in any market, whether it goes up or down. And we do this by investing the fund in a portfolio of companies that are in announced deals, as Bob just mentioned. There's a time lag between when a company announces a deal to when the deal is actually completed. Now, we profit from earning the difference between the share price of that target company where it's trading today compared to the consideration that those target company shareholders will receive when that transaction is consummated. Now, that difference we call the spread on any particular transaction, and it's really a primary driver for generating returns in this strategy. As Bob mentioned, Gabelli is known for its value style. Value investing involves buying undervalued companies, trading at a discount to its private market value with a catalyst. And many times that catalyst is a merger transaction, is some type of financial engineering where a company may spin off a business or split itself. So really, merger arbitrage investing has always been a natural extension of that. In merger arbitrage investing, we obviously are looking to earn a return on that transaction from when it's announced, from when it's completed. Now, what are the virtues of the merger arbitrage investing? Well, one is the variables that determine the outcome of a particular transaction are quantifiable. We can quantify a lot of the risk of some of the risk variables in a transaction. to determine the probability of completion. Whether that is, does the company have enough money to finance the transaction? Are there any regulatory bodies that might come into that might block the transactions? Are shareholders going to approve it? So a lot of those variables we can quantify. The other thing is that these transactions are generally non-market correlated. We have deal risk, not market risk, and deals generally get completed irrespective of market movements. So by combining these virtues of having quantifiable variables and being not market correlated, we're able to generate positive, risk-adjusted, consistent returns and preserve capital in any market environment with very low volatility. It's meaning very low risk. And very liquid as well, meaning that we can exit and enter positions very quickly. Now, one of the reasons why we're able to generate these positive risk-adjusted returns consistently is that the process we use is a very consistent, repeatable process. And it really, just to look at this chart briefly, it starts with idea generation, which generally will start with an announced deal from a press release or a company announcement, public filings, research and deal analysis, which I'll touch more about in a second, is really the main force in arbitrage. Trading, of course, is important. Being able to enter and exit positions and trade around them. Portfolio management, how the position fits in the overall portfolio and adds to either diversification or volatility. And risk management, and then we reinvest the proceeds and continually do that. I want to focus on the research part of the process because, again, that's the most important. I think that's really where we differentiate ourselves among others. And obviously, one of the first things we look at when a deal is announced is what's the strategic rationale for the deal. Why is the company buying another? Does it make a strategic rationale? Obviously, we study the merger contract, the merger agreement, which basically lays out the contract between the two parties, and see, what are the odds for the deal to be completed? What are the conditions? Is there a chance of another buyer coming in because the valuation? So fundamental valuation plays a key part in evaluating each merger situation. Obviously, we utilize our company and industry contacts to gather information, to look at the entire dynamics of that. And we carefully compose a risk-reward analysis to determine whether to enter to that position. And then, of course, we always have to look at what happens if the deal doesn't happen. So we have to weigh that variable as well. Identifying, quantifying, and managing risk really forms the foundation of our strategy. And the primary way we manage risk is the way we build the portfolio. Again, I mentioned we focus on strategic deals, not as much financial. Financial meaning buying by private equity, companies that are looking to be bought for a shorter time. We focus on deals that are strategic as they have a higher certainty of completion. We maintain a very well diversified portfolio, having 50 to 70 names. Also, our position size is usually limited to not more than 5% of the assets in the fund in any one particular transaction. We think both of those maximizes liquidity for us and minimizes any individual event risk if one thing were to happen for one particular name. Our holding period is shorter. It's usually around 90 days on average. We also think that mitigates some risk that's inherent in some deals that take much longer to complete. And we don't use leverage. We're probably one of the rare instances of this strategy being used on a very conservative basis where we don't use leverage, and that happens to fit very well under the UCIT guidelines as well. So the strategy how we manage it fits very well under the UCIT guidelines. And then, of course, we have a risk management team that oversees the entire portfolio on a real-time basis. It's made up of company officers, portfolio managers, and it's tracked in real time to gauge capital at risk, industry concentration, and a whole host of variables in real time. And then our advantage, I mentioned that research focus that Bob articulated, that we're founded on in the way we look at each particular deal as well. Our disciplined approach, we've had the same investment style and disciplined approach since the fund started in 1985. Very disciplined and risk adjusted. Experienced team, again, myself, Mario Gabelli actually founded the fund in 1985 and is also a member of the team, and also the two dedicated analysts who also have over 22 years experience. In our track record, this will be our 30th year track record investing in the strategy, one of the few that has such a long track record of investing in this merger arbitrage strategy.